Consumer spending is the biggest driver of both the U.S. and Canadian economies. And as we await GDP data for both countries later this week, let's bring in Benjamin Tal, Deputy Chief Economist at CIBC Capital Markets, to compare the consumer strength and confidence that's out there right now. Benny, the U.S. is in focus today with the consumer confidence data sliding a bit. There's going to be more data on the U.S. consumer later this week as well. What is your sense of how the U.S. consumer is doing?
They are doing okay, not great. The confidence going down, and the reason is that everybody was waiting for this recession to come, and we haven't received, we haven't gotten a recession. And one of the reasons is the consumer. The consumer was a big buffer in Canada and the U.S., protecting the economy from the sting of higher interest rates. Why? Because of this. Hundreds of billions of dollars of excess savings. We all talked about it many times. Now, in the US, these savings will go down to basically zero by October, November of this year, exactly when 45 million people will start paying student loans payments. So that's significant. So the consumer is not in a good mood at this point, although it's still doing extremely well, relatively speaking. The labor market is still relatively strong, although slowing. So we expect the consumer to slow down. Basically, will show zero growth in August in real terms, but still not collapsing by any stretch of the imagination.
How are Canadian consumers doing in comparison to the, American counterparts?
Well, the consumer confidence index in Canada is basically at a record low, if you wish, back to 2002 or something like that. So it's a significant decline in confidence for a good reason, because people know what's coming. What's coming is higher interest rates, higher interest payments, and our mortgage cycle is much shorter relative to the US, so we feel it immediately. So if you look at the consumption per capita in Canada, it's down. It's down compared to 2019. In the US, it's up. So this is significant. Per capita, we are down in real terms, lower than it was in 2019. So it's not even a trend. It's below where it was. That's significant. And I think that's one of the reasons why we are lagging the US. Remember, we know that those interest rates payments are coming. We know that those mortgage reset coming. And therefore, maybe we save a bit more. We feel a bit nervous about it, and we don't spend as much. I think the effectiveness of monetary policy, namely that Canada is more effective than the US, is clearly reflected in the psyche of the consumer.
Well, that's really interesting. That could be evidence there that the interest rate hikes are working, even though we, aren't really seeing the huge impact that many would like to see when it comes to inflation coming down. But we've also had this influx of people coming to Canada. So we have more people spending, even if they're spending less.
It's amazing. Even if you look at total consumption in Canada versus the US, not even per capita, we got 1.2 million people last year. The US hasn't received as many, clearly, in relative terms. And still, their consumption is faster than ours, suggesting that if we didn't have this influx of people, things would have been much worse in Canada in absolute terms. So this is not a real good model to follow, because per capita, as I said, it's down. So you're absolutely right to say that this consumer is not great. And yes, bingo, absolutely. Higher interest rates are working. The fact that the consumption per capita is down means that higher interest rates are working to slow down the economy in a very significant way. There is no need to raise again.
So, but if the data, like we're going to get GDP data later this week for Canada, if that comes in strong and sort of keeps the pressure on the central bank to do more, how do you look beyond those headline numbers to more of that per capita understanding of how people are experiencing these interest rate hikes? If the economy is still strong and inflation is still high, it does seem like there is still, work to do.
Yeah, so first of all, let's remind ourselves that GDP growth in the second quarter was actually negative. In July, we might get 0% growth. So the economy is not so strong. Remember, everything is poisoned, very foggy because of the strikes, because of the wildfires. So whatever numbers we get, you cannot take it to the bank, because it's really not clear where we are due to the fog of all those economic data. We'll get better numbers in September, but then it will be too late for the Bank of Canada. There are two numbers that the Bank of Canada will be focusing on. One is the unemployment rate, and the other is inflation before October 25th. They basically will have to see the unemployment rate rising by to 5.7, 5.8, and the inflation numbers to remain at about 0.2 in order to prevent them from raising interest rates again. That's a tall order. We might see a situation in which the Bank of Canada will move again in October 25th because the numbers will not be as weak as they would like it to see.
Well, there was a Bloomberg survey out today of economists, and it was pointing to no further rate hikes from the Bank of Canada, that the bank would stay at this level, though for quite some time, and perhaps not cut until, well, just once in the first half of next year. And then if you were to fast forward until the beginning of 2025, rates would still be at 3.5%. So the higher for longer idea that we hear a lot about out of the U.S. in particular, does that end up sticking here as well? Are we going to be dealing with these higher interest rates for quite some time? And what sort of impact does that end up having on these consumers that are, already pulling back?
Yeah, so we have to remember that interest rates will be lower than they are now, and that's a good thing. I think that the Bank of Canada should not raise interest rates again, but again, it's basically 50-50. I'm telling you that if we get the unemployment rate at about, 5.6 or only 5.5, not rising in any significant way, and the inflation numbers are a bit stronger than they would like it to be, they will raise again without thinking twice because they are very hawkish. And remember, this is a biased bank. They will take a recession over inflation any day, and that's more or less where we are. So the risk is definitely there, despite the forecast by the market. That's one thing. The other is, yes, I think that they will start cutting in late spring, early summer of next year, but they will go slowly, unfortunately. But they will start cutting, and when they finish cutting, it will be notably higher than when we started in 2019 due to the inflationary forces that will force them to raise interest rates higher than they were before, given inflation target at 2%.